Hi there, this is the Financial Accounting Tutor back with a notes receivable problem. Don't we all just love notes receivable? I know. I know. But let's get started though. Jasper makes a $25,000 90-day 7% cash loan to Claiborne Company. Jasper's entry to record the collection of the note and interest at maturity should be. So we're trying to see what the journal entry at the maturity is going to be. Now, what we do know is we know it's going to be a debit to cash and we know it's going to be a credit to notes receivable. That we do know. Because our notes receivable is going down because we're getting paid back and our cash is going up because they're paying us back. So we can eliminate D automatically. It says credit to cash. It's not going to be a credit to cash or a debit to notes payable. So we know it's going to be A, B, or C. Now, there's going to be interest on this loan because anytime you either make a loan or you're paying a loan, there's always going to be interest involved. So we know A is not going to be right. It wouldn't make sense to loan somebody $25,000 and get paid $25,000 when it says there's a 7% rate in here. So obviously if there's a 7% rate, then there has to be some interest involved somewhere. So we know it's not A or D. So that leaves us to either B or C. Now, let's see. Debit cash, $25,437.50. Credit interest revenue, $437.50. Credit notes receivable, $25,000. Debit cash for C, $25,437.50. Credit notes receivable for $25,437.50. Now, I just told you there has to be interest involved in this problem. So there's going to have to be some interest revenue somewhere. So we know C is not going to be the right answer. B is going to be the right answer. But how do you calculate the interest revenue? Well, what you got to do is you have to take the $25,000 times the 7%, and then we've got 90 days over 360. Now, you might look at your, financial accounting book. A lot of them use 360, but I've seen some that use 365 because, it's 365 days in a year. But 360 is easier for rounding purposes because it ends in 0. But, yeah, just check on that and then you'll know exactly. So if you just need to change this to 365, change this to 365. So the first thing we need to do is take 25,000 times the annual rate, which is 7%. Okay, that gives us $1,750. So now we need to take the $1,750 times the 90 days. Because you see it says 90 days up here. So if it was months, you'll use months. If it's days, you only use days. So if it said 2 months, you'll take 2 over 12. So in this case, it's days, so we need to take 90 over 360. And okay, so now we took the 1750 times the 90 days, and then we just need to take this number, and we need to divide it by 360. And that gives us 437.50. This is going to be the interest revenue. And there you have it. This is how you solve the problem. Just remember, there's always going to be interest revenue in a notes receivable. There's going to be interest revenue in there. So you need to find, number one, where the you need to find the answer that has interest revenue in there. Now, if it said what was the journal entry when we first issued it, then there wouldn't be no interest revenue because we haven't been paid back yet. We just issued it. But anyways, though, subscribe. Like I said, I'm going to be making a lot of videos on financial accounting. And I'll see you next time.